All right. So the reason why we're doing all of this stuff in this chapter is because tax and financial accounting don't have the same rules. They have some differences which impact us when we prepare the financial statements at the end of the year. It impacts more specifically the tax expense because that's where all the differences lie. So 2 words I'm going to be talking about a lot tonight, if I can switch my slide, all right, is accounting income and taxable income. So the accounting income is the income before tax that you've been calculating in 217 and in 310 is the one that's determined according to IFRS and ASPE. And taxable income is the new income here, especially if you haven't done ACCO320. It's determined according to the Income Tax Act. It's found in the tax declaration of the company. And the taxable income is actually the base for the amount of taxes that you're gonna pay back to the government during the year. So in previous classes, what you've done for the income tax expense is just use your accounting income and use a tax rate, and that's it. But that's not actually correct in practice. You have to base your tax expense on the taxable income. Some differences between financial accounting and tax is that under financial accounting, you're looking at transaction on an accrual basis. So for example, if I receive a paycheck on January 5th, 2021 for work hours I did in December 2020, well, this paycheck for me in my income statement is going to be recorded in 2020 because I worked in 2020, right? It's what you signed to 17. It's the matching principle. For tax, you're looking at the transaction on a cash basis. So for the same paycheck, since you received it in 2021 and you received the cash in 2021, the tax law wants you to add it to your income for 2021 because you received the cash in 2021, not in 2020. Also under tax, there's some expenses and revenues that are not admissible. So that means that in your accounting income, you've included some expenses and revenues that under tax laws you cannot add there. So you have to correct your accounting income to get to your taxable income to remove all these expenses or revenues that aren't admissible. I put here some examples like dividends from taxable Canadian corporations, fines and penalties. There's more. You have to be on the lookout while you're doing your problems for these. And there's no rhyme or reasons why these are there. It's just what's stated in the Income Tax Act. So that leads us to 2 types of differences. There's the permanent differences and the temporary differences. The permanent differences are caused by the expenses and revenues that aren't admissible under the tax legislation. So that's what I was just talking about, like the golf and meals and entertainment expenses. Those are never included in your taxable income. The temporary differences are the differences that are caused because of the difference in cash versus accrual. So like the paycheck example, that's the temporary differences. Temporary differences, eventually they're gonna net out. So what I mean by that is if we're taking your paycheck example, in 2020, for my tax declaration in 2020, what I'm gonna do is, since in my accounting income, I have this paycheck that's included, I'm gonna remove it to get to my taxable income. So my taxable income of 2020 will not include that paycheck because I didn't receive it cash. In my tax declaration for 2021, I'm gonna have my accounting income that doesn't include the paycheck. And to get to my taxable income, I'm gonna add the amount of the paycheck to add it to my taxable income to calculate my tax expense on. So in 2021, you're removing it. In 2021, you're adding it. So a minus plus a plus, if that makes sense, cancel each other out. So the effect of that paycheck has been reversed. Permanent differences, they're never going to be reversed. They're never going to be included in your taxable income. So when you're going to do the journal entries later on, you're never going to do a journal entries for impairment difference. All you're going to do, you're just going to correct them when you're calculating your taxable income for the year. The reason for that is that there's no future impact of that difference. It's not going to impact you in future years. You just disregard it. When you're doing problems, what you can look for is keywords like non-deductible for tax purposes, non-taxable, or if there's only a percentage that's tax deductible, or only a percentage that's non-tax deductible. For temporary differences, I put some examples here, but just know that there might be more. It depends on your problem. So the more problems that you do, the more you're going to see the different types of temporary differences. For revenues, some examples are installment sales, where you're going to recognize your sale. Let's say you have an installment sale in 2021 of $50,000, and the client is going to pay you an installment where they're going to pay $20,000 in the first year, $20,000 the next year, and then $10,000 in the third year. So in your accounting income, you're going to include the full $50,000 for 2021. But under tax, they're like, no, you didn't actually receive that amount of money. You only received $20,000, if that's the number I've said. So what you want to do, you want to adjust your accounting income by removing the full $50,000 that you accrued under accounting. And you're going to add the $20,000 cash that you've received from your clients to get to your taxable income. And then in future years, in your accounting income, you have not accrued anything for that installment sale, but you've actually received $20,000 or $10,000 cash related to that sale. So you want to adjust your accounting income to add that $20,000 or $10,000 to get to your taxable income for the year. Subscription, same principle, but reverse. It means that you receive, like, let's say you're a magazine company and people pay 3 years in advance for their magazine subscription. So you're gonna receive 3 years worth of sales in 1 year. So $50,000, but you haven't yet delivered the magazines to those people. So you haven't yet in your financial statement recognized this sale as revenue. You only put it as unearned revenue. So what you need to do is that in the year where you receive the cash, this is all in your revenues in your taxable income. So you have to adjust your taxable income to add all the cash that you've received. And then in future years, when you're going to accrue your unearned revenue and turn it into sales revenue, you're going to want to remove that amount because you didn't receive it cash. If at any point you have any questions about what I'm saying, just write in this chat or just like unmute yourselves. Rent revenue is the same principle as subscription, where sometimes clients are going to pay you for rent in advance. So you're going to want to include that cash amount that you've received in the year that they've paid you. And royalty revenue, same thing. For expenses, there's a depreciation versus CCA. Depreciation is what you've seen in your accounting classes. CCA is the tax depreciation. Why they're not using the same type of depreciation is that under financial accounting, depreciation has a lot of professional judgment that goes into it. So things like your salvage value or your residual life of your assets can really be up to management. Tax doesn't like that. There's too much judgment. Management could use that at their advantage to play with how much income tax they're going to pay for the year. So what they decided instead is that they created classes of assets, and your assets are going to fit in one of those classes. And depending on the class, they state how you need to depreciate it. So that creates some differences in the depreciation expense in your financial statements. For warranties, if you remember midterm stuff, maybe you all forgot it, but warranties, what you're doing is when you have a warranty expense is because you've you've based, you kind of, I'm forgetting the word right now, but you're approximating how much that warranty is going to cost you in future year, and you expense it in your income statement for that year. But you don't actually pay any warranty. It's just an approximation of how much you think. Tax doesn't like that. You're not paying any cash. What they're going to want you to do is remove that approximation of warranties, and you're only going to deduct it in your taxable income when you're actually paying money to fulfill your warranties. Lawsuit accruals, kind of the same thing as warranties, is you're setting up an expense for the amount that you think that you're going to pay in future years for that lawsuit, but you're not actually paying it. Tax wants you to remove that provision that you've set up, and you're only going to deduct your lawsuit expenses when you're actually going to pay them. Hold on, it's not working. Okay, so how do you calculate your current tax expense? So how do you calculate the amount of taxes that you're going to owe for your financial year? You always start with your accounting income. So what you have pre-tax in your income statement. Then you're going to add or subtract your permanent and temporary differences, and that's going to give you your taxable income. From there, you take your tax rate, you times your taxable income, and it gives you the amount of tax that you owe to the government for the year. For your permanent and temporary differences, when do you know when to increase it or when to decrease it? So you add it as a positive when it increases the taxable income. So you're adding revenues that weren't included in your accounting income, or you're removing expenses that were included in your accounting income. So here, if you in your accounting income, it's missing $50,000 worth of cash that you've received during the year, you're going to add it, and your taxable income is going to be $50,000 higher. Here, if you have expenses you've accrued but you didn't pay cash for, well, they're included in your accounting income, right? They reduce your accounting income. So you want to put it as a positive to remove that effect that it had on your accounting income. So it would increase your taxable income at the end of the day. When do you decrease the taxable? Well, you subtract your differences when it decreases the taxable income. So it's the reverse of this. It's when you're removing revenues that were included in your accounting income, or when you're adding expenses that weren't included in your accounting income to get to the taxable income. There's two types of method. The taxes payable method is only allowed under ASPE. It's a lot easier than the other method, as I think you guys know. So what you do under the taxes payable method is you're taking the taxable income that you found here, and you do times your tax rate, and that gives you your income tax expense. And that's it, you're done. So your income tax expense will reflect the temporary and permanent differences, but the rest of your financial statements won't. So it's only here that you're going to be able to tell if you have permanent or temporary differences. The other method is the deferred/future income tax approach. So under IFRS, it's called deferred tax, and under ASPE, it's called future income tax method, but it's the same logic, just different account names. And throughout the tutorial, I'll be using the deferred tax accounts, just so you know. But basically what you're doing is that you adjust for the effect of the temporary differences, only the temporary differences, in assets and liability accounts. And you recognize these effects in an expense/benefit or a provision, I think your teachers use also. So that means that the impact of your temporary expense, temporary differences are going to get reflected in your balance sheet and your income statement. Why they're doing that is because your temporary differences are going to get reversed eventually. So they're going to affect in future years the amount of taxes that you're going to owe to the government. Either you're going to have to pay more taxes in future year, or you're going to have to pay less taxes in future years because of those temporary differences. The goal of this approach is that your deferred tax expense, which reflect your temporary differences, plus your current tax expense, which is the amount of taxes that you're going to owe to the government for that year, is equal to your tax rate times your accounting income minus the permanent differences. So no need to remember this by heart. It can be just a trick during the exam if you want to verify that your accounts have the right amount. The goal here is not fulfilled if you're using the taxes payable method, since we don't have a deferred tax expense account. So when do you know if it's an asset or a liability? An asset is going to be when the temporary differences cause the company to pay less taxes in the future. So your taxable income for the year is going to be greater than your accounting income. So you're paying more taxes now and less taxes later because the reversing effect. So for a liability, it's if the temporary differences cause the company to pay more taxes in the future. So you're going to owe money, like an account payable, you're going to owe money. That happens when your taxable income for the year is smaller than your accounting income. So that means that you're paying less taxes this year and you're going to be paying more taxes this year because your taxable income this year is smaller, but it's going to be bigger in future years. We're going to see that effect in some problems that we're going to do a little bit later. So as a rule of thumb, to know when it's a liability or an asset, for expenses, the expense in your financial statement versus what you actually paid. If the expense in your financial statement is smaller than what you actually paid, it's going to be a deferred tax liability. And if your expense in your financial statement is greater than what you paid, it's going to be a deferred tax asset. So here, your expenses in your accounting income are smaller than what you paid. So when you're going to adjust for your temporary differences in the little equation I showed earlier to get to your taxable income is going to be smaller than your accounting income at the end of the line. So you're paying less taxes this year, more taxes in future years. And reverse for if the expenses are bigger than what you paid. For the revenue in your financial statements versus what you actually collected, it's if your revenue in your financial statement is greater than what you collected, it's going to be a liability. And if the revenue is smaller than what you collected, it's going to be an asset. So you can refer to that when you're doing examples, this and also the previous slide here, to know if it's an asset or a liability. It's useful. And then here are some examples. So installment sales, I explained the concept a little bit earlier. So what happens is that they are taxed later as cash is collected. As an example, if your installment sales in 2021 gave $60,000 in profit recognized for accounting purposes in 2021, but you only collected $20,000 per year through 2021, 2022, and 2023. Your tax rate is 30% and the accounting income is $250,000 for all 3 years. So in 2021, in your accounting income here, you have $60,000 that's due to the installment sales, but you didn't receive the full $60,000. You only received $20,000 cash. So to get to your taxable income, you're going to want to remove the $60,000 that you've put in your book and add the $20,000 cash that you received, or just adjust for the $40,000 difference that it causes. So you're going to remove the $40,000 in cash that you didn't receive for those sales. So because of that, your 2021 taxable income is going to be lower than your accounting income for 2021. So you're paying less taxes in 2021. For 2022, what's going to happen in your accounting income, you didn't recognize anything related to installment sales, but you did receive $20,000 in cash during the years. Tax says, oh, well, you received it cash, so you did receive some revenue during the year. So they're going to want you to add the $20,000 in cash that you received throughout the year. And that's going to increase your taxable income to $270,000. Same impact in 2023. So you're paying less taxes in 2021, but in future years, compared to your accounting income, you're paying more taxes. So that means that you have a deferred tax liability. Your taxable income is less than your accounting income, and you're paying more taxes in future years. For 2021, what you want to find first is your current tax expense. So how much tax am I going to pay for this year? And to do that, you take your taxable income times your, and I have a question in class. We're giving example for lawsuit expense, for rent or royalty revenue. Yes, you might be tested on them. In one of my examples, we're going to see a lawsuit expense and rent revenue also, but keep in mind that it's, once you get kind of the logic behind it, it's almost always the same thing that you're going to do. You're going to remove the financial accounting effect, and then you're going to add your tax effect in your taxable income. No problem. But you're going to see later on for rent and lawsuit expense what we're going to do. But the more practice that you do, the more you're going to see the different types of differences that can show up during your exam. Because some of the things that didn't show up during your class might show up in your exam, and you need to be ready for those. All right. So, so your current tax expense, your taxable income times your tax rate. For your deferred tax liability, how you calculate it, you use your sum of your temporary difference, and you time it times your tax rate. So here is 40,000 times 30%. Another trick that you can use is if the sum of your temporary differences is negative, then it's going to be a deferred tax liability. If it's positive, it's going to be an asset. So you can use that also to when you're doing exercises. And then you have your income tax payable for the same amount and deferred tax expense for $12,000. For 2022 and 2023, you're going to first calculate your current tax expense, which is 270 times 30%. And then here, the $20,000 is added to your income, which means that it's reducing your liability. So you're going to want to reverse, well, to decrease your liability account by the amount of temporary differences times your tax rate. So that gives us $66,000. And you're going to put it in the deferred tax benefit. So basically the reverse of an expense, like kind of a gain on your statement for $6,000. And then in 2023, it's going to be the same transaction. So you see that you're at the end of 2023, 6,000 plus another 6,000, your liability is going to be net out. It's going to be at zero. So the entire effect of the installment sale is going to be canceled. Not canceled, but like reversed. All right, for subscription sales, it's taxed earlier as cash is collected in advance. So subscription sales in 2021 gave $60,000 in profit recognized for tax purposes in 2021. But for ACCO purposes, you only recognize $20,000 per year through 2021, 2022, and 2023. Same tax rate, same accounting income. So here in 2021, in your accounting income, you recognize $20,000 of that subscription sale. But for tax, they're like, no, you received $60,000. You didn't receive only $20,000. So you need to increase your accounting income by $40,000 to get to your taxable income to reflect all the cash that you've received during the year. For 2022 here, in your accounting income, you also accrued $20,000, but you didn't receive any money. So tax wants you to remove it to show the actual cash that you received during the year. And same thing for 2023. So for 2021, your current tax expense, same thing, taxable income times your tax rate. Here, since your taxable income is greater than your accounting income, you're paying more taxes this year, and you're going to be paying less taxes in 2022 and less taxes in 2023. So that means that you're kind of going to receive an amount of tax, not receive actually, but you can see it like that. It's like a receivable, you're paying less taxes. And so you're going to set up an asset. The asset is going to be your temporary difference times your tax rate. So $40,000 times 30%. And then you're going to have your income tax payable account and your deferred tax benefit account. For 2022 and 2023, again, current tax expense, taxable income times tax rate. And here, your taxable income is lower than your accounting income. So your temporary differences is in the negative compared to the positive here for 2021. So that means that you're gonna reduce your asset for the amount of $20,000 times 30%. Why did I put 10,000? Hold on. It's supposed to be $20,000 here. I think the math still works, but put $20,000 here instead. And same thing for 2023. So at the end, your deferred tax asset is going to be at 0 at 2023 for this sale. For warranty expenses, it's taxed later as cash is collected. So same principle as installment sales. So a warranty expense estimation in 2021, giving $60,000 expense recognized for ACCO purposes in 2021, but you actually spent $20,000 through 2021, 2022, and 2023 for warranties. Your tax rate is 30% and accounting income of $250,000 each year. So here, in your accounting income, you have deducted from your, well, you have $60,000 expense of warranty expense. So it's lowered by $60,000, but you didn't pay $60,000, you paid $20,000 for your warranty expense. So you lowered your accounting income by $40,000 when it shouldn't have been the case. It should only have been lowered by $20,000. So you're gonna want to add back $40,000 to get a taxable income of $290. So here, before, it's a little bit simpler to think about the effect of the temporary difference because you're comparing incomes with revenue with income. Here you have to think that your expense has a reverse effect as of your revenues. So when you want to add back your expenses in your accounting income, you want to use a plus, because if you use a minus, you're actually reducing even more your income. For 2022, here, you don't have any warranty expenses in your accounting income, but you actually paid $20,000 cash. So you want to reduce your accounting income by the $20,000. And same thing for 2023. So here for 2021, you have a deferred tax asset. You're paying more taxes this year, less taxes in future years. So it's the same amount, 12,000, so 40,000 times 30%. And then for 2022 and 2023, you're gonna reduce your tax asset by the temporary differences for those 2 years. So at the end of 2023, your tax asset account is at 0. For depreciation versus CCA, what happens most of the time is that CCA is a percentage of the value of the carrying value of the asset. So what happens is in the first few years, your CCA is probably going to be bigger than your depreciation expense. And as time goes on, it's going to switch. Your depreciation expense is going to be bigger than your CCA. And eventually it's going to re-switch that your CCA is bigger than your depreciation expense. So here, for example, they had an asset that is worth $100,000. It is a CCA class 8 assets, so it's depreciated 20% per year for tax purposes. And in your financial statement is depreciated over 8 years using the straight line method and no salvage value, you have a tax rate of 40%. So your first year, if you do $100,000 divided by 8, in your book, you're going to have recorded a depreciation expense of $12,500. In your tax return, you're going to have reduced the $100,000 by 20%. So it's going to be $100,000 times 20%, so $20,000. So the difference between the two is 7,500. So CCA is higher by 7,500. Since it's higher, you're going to want to reduce even more your taxable income by $7,500. So you're paying less taxes right now and more taxes in future years. So you're going to be setting up a tax liability. You're going to be setting up a tax liability as long as the difference between your CCA and amortization is positive. So until up to year 3 here, you're going to have a tax liability. So at the end of year 3, in your balance sheet, you're going to have a deferred tax liability of $4,520. What's going to happen in year 4 is, well, my depreciation now is higher than my CCA. So I want to come and reduce my liability. So I'm going to reduce this by $904. So now I have a tax liability of $3,616. What happens in year 6 here is that you completely reduce your tax liability. So it becomes now a deferred tax asset. And it's going to be a deferred tax asset up until you're done with you're calculating the CCA. So up until this column here is equal to the value of your asset of $100,000. When that is equal to $100,000, you're not going to have any asset or liabilities for tax in your balance sheet. And there's going to be no impact in the future because you're done depreciating. So over the long term, the timing differences even out and offset each other. All right. So any question for deferred tax assets and liabilities? Because that was my whole spiel. We're going to move on to another subject. So what might happen also during the year is that there might be a change in tax rate. So when that occurs, you need to adjust your deferred tax assets or liabilities immediately as it occurs. And you're going to record like the other leg of your transaction is going to be either an expense or a benefit. That's because since your deferred tax accounts are set up for future tax impacts, they need to be at the same rate as your current tax rate. Well, not current, as your future tax rate, because it's reflecting your future tax impact. So for example, if the tax rate for 2022, so if the tax rate for next year changes in 2021, in this current year, you calculate your deferred tax account using the tax rate of 2022. So your current tax expense, so the amount that you're going to pay, is going to be using your 2021 tax rate, but your deferred tax accounts are going to be using the 2022 tax rate. If the tax rate for 2022 changes in 2022, well, you're going to have to adjust the deferred tax accounts that you set up in 2021 and in previous years to reflect the changes in 2022. I have 2 examples. So here you have temporary differences in 2021 of $10,000. Your 2021 tax rate is 25% and 2022 tax rate is 30%. So first is, if your 2022 tax rate changes in 2021, you're going to take your temporary difference of $10,000 and you're going to time it times your 2022 tax rate of 30%. So that's going to give you a deferred tax asset of $3,000. Here, if your 2022 tax rate changes in 2022, what would have happened in 2021? You would have set up your deferred tax asset using the 25%. So it would have been $2,500. But now your tax rate is 30%. So you need to increase your deferred tax asset to reflect that increase in tax. So in 2022, as soon as you know that the tax rate changes, you're going to do 10,000 times 30% minus 25%. So that's going to give you $500. So in 2021, you have 2,500 in your balance. You're adding $500. So that gives you the same amount as here, $3,000 in your accounts. And then for loss carryovers, this happens in tax. So basically when your taxable income is a loss, so it's in the negatives, you're not going to be paying taxes for that year. And tax laws allow that this amount be applied to taxable income from previous and future years to reduce the amount of taxes that you are going to pay in future years, or to get a refund for the taxes that you paid in previous year. When you carry it to previous year, it's called a carry back or carry backward. You can apply it to taxable income from maximum of 3 previous years. So let's say I have a tax loss this year, and I had in 2020 I had a taxable income, in 2019 I had a taxable income, and in 2018 I had a taxable income. Well, I can go back to 2018 to apply that loss from 2021 too, but I cannot go to 2017 because the time frame is done. For if you want to carry it forward to future years because you think that you're going to have profit in future years, you can apply it to taxable income for up to 20 years. So 2021, I could go up to 2041, keep it in stock. So for loss carrybacks, if a loss is carried back, usually it's applied against their earliest available income. So normally when you're using when you have a loss carryover, you're always going to want to look first to your previous years, see if you had any taxable income and see if you had any taxes that you paid in previous year, because you want to get your refund as soon as possible. So you applied it against the taxes that were paid in previous year. So the example here, I have in 2021 a tax loss of $180. 2019, I have a tax income of $150, and 2020, I have a tax income of $30. So if I add them together, they equal $180, right? So that means that I can claim a refund for the amount of tax that I paid for those 2 years. So I can claim a refund for $60 and $12, so $72. So since the tax income from 2019 and 2020 are equal to your loss from 2021, the entire tax loss has been used. So you're good to go. You're getting your money back and you continue on with your life as if nothing happened. But what happens if you still have a balance of your loss after you're applying it to previous years? So here, same numbers, but instead in 2021, I have a loss of 280. Well, after I apply it to 2019 and 2020, I still have a balance of loss of $100. I still have a loss of $100. So that $100 can be set up as a tax asset, as a receivable for the expected amount of future income or future taxes that you're going to pay. You have to keep in mind that this can only be done if it's more likely than not that you're going to have taxable income in future years. If you think that for 20 years you're only going to have losses, well, you're not going to be setting up that deferred tax asset because you're not going to use it. So what you're going to do is, well, if you can't use it, if you think that you're going to have a loss for the next 20 years, you need to disclose it in your notes in your financial statement and say how long you have it, what's the balance and like the remaining time frame that you have to use it. So in 2021, I have 20 years to use it. So I'm going to say I have that carry over for 20 years. But if you think that you're going to have taxable income in future years, you're going to set up your asset account, and that's going to be the balance of your loss times your tax rate. So let's say here the tax rate was 40%, so you're going to have set up a deferred tax asset of $40. And I think, no, that's not it. When you're going to apply that balance to the future years, so when you're going to use it as a carry forward, what you're going to do is you're just going to reverse your account. So you're going to net out your tax asset that you set up and put it at and net out your tax benefit. If between the years there's been a change in tax rate, well, like we saw earlier, since it's a deferred tax asset, you're going to adjust it for the change in tax. So it should reverse itself eventually. All right, so that's it for the theory for tonight. We're going to jump in the problems. Let me just change some things up. All right. Okay, so question one. In question one, you're going to see rent revenue and you're going to see the rent revenue caveat. So ABC Inc. reports accounting income of $150,000 for 2021, its first year of operations. The following items cause taxable income to be different than income reported on the financial statements. So when I'm going to be reading this, I want you guys to think, is it a temporary difference or a permanent difference? So for the first item is that ABC Inc. uses the straight line depreciation for book purposes and recorded at $20,000 in the year as depreciation expense. For tax purposes, it recorded $35,000 of CCA in the year. For item 2, rent revenue reported on the tax return is $35,000 higher than rent revenue reported on the income statement. Meals and entertainment expense was $25,000, which is 50% tax deductible. And ABC's tax rate is 25% for all years, and the company expects to report taxable income in all future years. ABC reports under IFRS. So the first requirement is to reconcile your accounting income to your taxable income, calculate the amount of taxes payable and the income tax expense for the year, and provide the tax-related journal entries. So what you're going to do first, you always start by your accounting income. It should be given. Sometimes they might give you an income and there might be a gain or loss also in the items here. If there's a gain or loss, you need to adjust for it before doing your permanent differences. So say I had a gain too, I would have had my gain here, and then I would have had my accounting income. So for this question, the accounting income is $150,000. Now for my permanent differences, I'm gonna go back, and is there any that sounds like a permanent difference? So any that under tax laws are not deductible? Well, straight line depreciation and CCA, that's fine. Our rent revenue is higher, that's fine. Meals and entertainment expense is 50% tax deductible. So that's a permanent difference. That means that, well, in your accounting income, you put the full 100% of meals and entertainment expense. But for your taxable income, you're only allowed 50%. So you're going to want to add back 50% of your meals and entertainment expense to get to your taxable income. So meals and entertainment expense is going to be $25,000 times 50%. I added back as a positive because here I took it out. It reduced my account income. So now I want to add it back and increase my taxable income for the amount that I deducted earlier. And that's the only permanent difference for that question. Then we go to the temporary. Well, you should always, before I jump in, you should always calculate your income after your permanent differences, because it's going to make it easier later on in the problem. And you have your temporary differences. So here you had 20,000 in depreciation in your books. So I'm going to want to add it back. I reduced my accounting income by $20,000, but for tax, the CCA was actually $35,000. So minus $35,000. So here, this is my ACCO, and this is my tax transactions. So I'm adding back the effect of my accounting transaction in my accounting income, and I'm using only the effect of the tax to calculate my taxable income. The transaction here is the sum of the difference between the two. It's going to create minus $15,000 in differences between your accounting income and your taxable income. So it reduces your taxable income by $15,000. So that's the deferred tax liability. So your transaction is going to be a deferred tax expense and deferred tax liability. The amount is going to be $15,000. So the sum of $20,000 plus minus $35,000 times your tax rate of 25%. For item 2, your rent revenue, it says that the rent revenue reported on the tax return is $35,000 higher than rent revenue reported on the income statement. So here, you're going to want to increase your accounting income by $35,000 to get to your taxable income, because your taxable income has $35,000 more than your accounting income. So you're adding $35,000. I'm going to move these a little bit higher. Yeah, here. Which one? The one for CCA or the one for rent revenue? Rent, yeah. It says here that what I have on my tax return is $35,000 higher than what's in my books, what's in my income statement. So when you're looking at your accounting income, it's what's in your books. So here, you're missing the $35,000 that's higher in your taxes. So you want to add it to get to your taxable income here, because your taxable income is going to be at least $35,000 higher because of that difference between the two. Didn't make sense? Yeah. Okay. For those, I think there's a bunch, like the exercise problem in the books, they go over a lot of these types of small problems. So I think it'd be useful for you to go over them and kind of understand what's going on. Yeah. You still have time until your final to look over it. So don't worry, it's normal that it's kind of confusing right now. All right, so since you're adding $35,000 more in your taxable income, it's going to create an asset because you're paying more taxes now, less taxes in the future. So it's going to be a deferred tax asset, and here is going to be a deferred tax benefit. The amount is going to be the sum of the temporary difference for this item, so $35,000 times 25%. And then you have, is that it? That's it. So now you get to your taxable income. So your taxable income is going to be the 162,500 plus your $20,000 plus your minus $35,000 plus your $35,000. So you get a taxable income of $182,000. 182,500. So here, your accounting income with your permanent differences is lower than your taxable income. In your balance sheet, if you add your deferred tax asset and deferred tax liabilities, well, you have more tax asset, right? So in your books, you're going to have a deferred tax asset of $5,000 if you net those two accounts together. The other way you can find that $5,000 is if you sum all your temporary differences together, should give the same amount. Oh, should give the same amount if you do it times your tax rate. Another way that you can think about if it's an asset or a liability, if the sum here is positive, it's an asset. If it was negative, it would be a liability. Right, so now we have our taxable income. So you want to find how much taxes are you going to pay for this year. So your tax rate is 25%. So your current tax expense is going to be 182,500 times 25%. So you're going to pay in taxes $45,625. So your transaction is current tax expense. This amount, oops, the 45,000. You're going to have a deferred tax asset for $5,000. You're going to have income tax payable for $45,000, and you're going to have a deferred tax benefit of $5,000. For B, it's asking you to do the income statement starting from net income before tax. So your net income before tax is your accounting income. So it's going to be net income before tax. It's $150,000. Then you're going to have the current tax expense. So how much taxes you're going to pay. Yeah, no problem. I can re-explain it. I'm just going to finish part B and then I'll go back to the rent revenue. So your current tax expense is $45,000. So that's lowering your income for the year. Then you have your deferred tax benefit. It's a benefit. So you're adding the amount to your income. So it's increasing your income. So it says it's a positive. And that gives you your net income after income taxes of $109,375. For the rent revenue here, I added it as a positive, the whole amount as a positive, because under tax, my income needs to be $35,000 higher than what I put in my books. It says here that my tax return, the rent revenue reported on my tax return is $35,000 higher than the rent revenue reported on the income statement. So you receive $35,000 in cash during the years, but you didn't record that $35,000 in your sales revenue. It could be in your unearned revenue because it's actually for the rent for like March 2023 and you just received it in advance. But for tax, since you received it cash, it's added to your revenue. So because it's not here in your accounting income, you have to increase your taxable income by $35,000 to reflect the cash that you received during the year for rent. Is it clear? No problem. If you're doing, when you're doing exercises, if you're still confused about that, don't hesitate to just write to me on Facebook. All right, for C, if the tax rate for future years will change to 30%, and that is known in 2021, would you make any changes in the journal entries in Part A? Yeah, you would. So here, you set up your deferred tax asset using 25% tax rate. But you already know that in the future, your tax rate is going to be 30%. So it's going to be 5% higher. Because your deferred tax asset account, well, your deferred tax accounts in general, reflect the future impacts for your taxes, you need to make those accounts with your future income tax rate. So instead, since you know in 2021, instead of putting your deferred tax asset as $5,000, so it's 20,000, I think, times 25%, you're gonna wanna set it up as, I'm not gonna do that here. I'm just gonna copy this here. So you're gonna wanna set it up as your sum of your temporary differences times 30%. So it's going to be $6,000 instead of $5,000 because your tax rate for 2022 is going to be 3% instead of 25%. Your current tax expense doesn't change. For 2021, your rate is still 25%. So you're still paying 25% of your taxable income. So that would be what is the transaction instead. If you knew that your tax rate for future years will change to 30% in the current year. For D, it's that the tax rate for future years changed to 30% in 2022. So not in the same year as you did this transaction. So prepare the journal entries to reflect this change. So 30% minus, so 30% is the future tax rate. You recorded your deferred tax asset and deferred tax benefit at 25%. So you're gonna want to increase those two accounts by 5%. So it's as if you recorded them at 30%, a lot of percentage here. So you're gonna want to increase your deferred tax asset and deferred tax benefit. You're increasing them because your tax rate has increased. So it's gonna be the sum of your temporary differences for 2021 times your 30% minus 25%. So you're gonna add $1,000 in those two accounts so that now the balance is at a 30% tax rate instead of a 25% tax rate. So that's it for question 1. Then for question 2, it's that Raleigh Inc. reports the following pre-tax incomes and losses for both financial reporting purposes and tax purposes. So their accounting income and their taxable income is equal. There's no temporary or permanent difference. So here you have the information. It says that the tax rates listed were all enacted by the beginning of 2018. Raleigh reports under the ASPE future deferred income taxes method. So first, what you're going to do is you're going to want to prepare the journal entries for each of the years 2018 to 2021 to record income tax. Assume that the tax loss is first carried back, and then at the end of 2020, the loss carry forward benefits are judged more likely than not to be realized in the future. Here, this sentence here would have been useful if you had temporary or permanent differences, but it's not the case. So you can just not care about it. So your transaction for 2018. So you had, and you want to only record your current tax expense for 2018. So how much taxes that they paid. Amount is going to be your $120,000 times 25%. And that's it for 2018. For 2019, again, you want to do the same transaction. But now their accounting income was $90,000 times the same type tax rate of 25%. In 2020, they have a loss. So they're not going to be paying any taxes in 2020, but what they can do is they can carry backward that loss and use it to receive a payment from the government for the amount of taxes that they paid in the last 3 years. So what that means, they can get a refund of $30,000 and $22,500 if the loss is equal or bigger than the accounting incomes for those 2 years. So we're going to see my loss for 2020 is $280,000. You want to carry it back to the first year as far away as you can. So first I'm going to look, my accounting income for 2018 was $120,000. All right, that works. I still have some balance, and I could go and look for 2019 to deduct the income there too. So minus $90,000. So after, okay, I'm going to do the transaction first to pay to receive the amount for those two amount of taxes. So the reason why I check this here, I check this to see, okay, is my accounting loss big enough to cover my accounting income from 2018 and 2019? Because if it's big enough, then I could get all the taxes back that I paid for those 2 years. If it wasn't big enough, then I would have had to only receive partial amounts for these 2 years. So most likely what would have happened is I received back all the taxes I paid for 2018 and only a portion of taxes that I paid for 2019. So transaction for, since it's more likely than not that they're gonna have taxable income in the future. No, that doesn't matter for here right now. It's gonna be for the other transaction. Here, you're gonna want to set up an income tax receivable and a current tax benefit. What that does is basically you're going to receive the amount of taxes that you paid in the 2 previous years by the government. So it's going to be $120,000 times 25% plus $90,000 times 25%. And your current tax benefit is the same amount. So it's the same amount as those 2 expenses that you had. And since we still have a balance of $70,000 of our loss that we can use, you have to look, okay, is it more likely than not that I'm gonna have taxable income in future years? They say here that they judge that it's more likely than not be realized in the future? So that means yeah. So that means I'm going to set up a tax asset. So your deferred tax asset and a deferred tax benefit. It's going to be your balance of your loss of 70,000 times your current tax rate, so times 30%. So that gives us a deferred tax asset of $21,000. I use the 30% here instead of the 25% because it's more, your tax rate is going to be 30% also for 2021, and there's no clue of what it's going to be for future years, but you have to assume that it's going to be 30% also. If here in 2021, instead of said 35%, then you would have set it up as 70,000 times 35%. All right, for 2021, you had an accounting income of $220,000. So what's going on here? You're gonna want to use your deferred tax asset, right? It's like, okay, well, I'm not gonna pay all that tax when I have that carry forward that I could use. So you're gonna use the balance. You're gonna reduce your deferred tax asset. And your deferred tax benefit. So you're gonna wanna reverse the two accounts that you set up earlier in 2020 for the amount that you recorded. Why is it the amount that I recorded? Is because the balance of your loss, your 70K, is smaller than your accounting income in 2021, 220K. So you're going to be using the whole deferred tax asset that you set up. So now, okay, well, I used the whole balance of my loss, but now it reduced my taxes, but I still have taxes to pay. So the taxes that you're going to pay is going to be current tax expense to income tax payable. It's going to be 30% times 220,000, so your accounting income, minus 70,000, your loss balance from 2020. So it's going to be $45,000. For B, using the assumptions in Part A, prepare the income tax section of 2020 and 2021 income statements, beginning with the line income loss before income tax. So for 2020, you're going to have your loss before income tax. It's minus 280,000. You're going to have your income tax benefits. So you have your current benefit to loss carry backward, and that's going to be here, 52,500. And you're going to have your future benefit due to loss carry forward. And that's going to be your 21,000 here. So if you add them together, you have total benefits of $73,500, which should be equal to $280,000 times 30%. No? Oh no, because it's different tax rate. Forget what I just said. And then your net loss for 2020 is going to be your $280,000 plus your $73,500. For 2021, you're going to start with your income before income tax. That was $220,000. And you're going to have your income tax. So first, you're going to reduce your future benefit. So you're going to reduce your section by the $21,000 here. So is the future benefits due to a loss carry forward. So that's minus $21,000. And then you're going to have your current tax expense. So whatever amount that you paid, which is $45,000. Hold on, I lost myself a little bit. Okay, so if you add them together, it's reducing your income by $66,000. So your net income after tax is of $220,000 minus $66,000, so $154,000. All right, part C. Prepare the journal entries for 2020 and 2021. Assume that it is more likely than not that 1/4 of the carry forward benefits will not be realized. This company does not use a valuation allowance. So what's going on here? It means that instead of having the 100%, which is the loss of $280,000, that is more likely than not to be realized, you only have 75%. So that will be equal to $210. So the transaction we did in 2020 and 2021, it was based on the fact that the balance, the whole amount was going to be realized eventually. But now instead of starting from $280, we're going to start by $210. So that's going to reduce probably, that's going to reduce your future benefits due to loss carry forward. And that's going to increase your current tax expense for 2021. So we're going to redo the transaction for 2020. We're going to check, okay, is my accounting income from 2018 and 2019 fit in my loss from 2020? So 210 minus 120,000 minus 90,000. That gives me 210 minus 120 minus 190. I don't think it, wait. 210 minus 120 minus 120. Huh, hold on. I think I made a mistake in my correction here. Huh. Okay. So that gives us 0. So what's going to happen here? You're going to use your entire loss for your 2018 and 2019 years. So you're going to have your income tax receivable and your current tax benefit. And they're going to be both of your $120,000 plus $90,000 times 25%. You're not going to have any deferred tax asset because you have no more loss to use. Your balance of your loss is equal 0. So for 2021, you're going to have to pay your taxes on the full amount of your accounting income. So it's going to be $220,000 times 30%. And for 2020 and 2021, That's D, by the way. Sorry, I jumped. For D, they want you to do again the income statement. So for your loss before income tax for 2020 is $280,000. Current benefit due to loss carry forward is again going to be $52,500. You don't have any future benefit, so your net loss is going to be $227,000. For 2021, your income, you have no benefit due to loss carry forward, and your current tax expense is minus $66,000, so that gives you a net income of $154,000. See how this is equal to this? It's normal because here you're paying a little bit more taxes, but it's calculated on the same tax rate. So it's normal that here and here it's equal. All right, for question 3, that's a long one. Sorry guys, it's a long session tonight. That's actually the question I got in one of my assignments. And I like this question because it's your textbook problems most of the time is only like 1 or 2 temporary difference, and then you go on about your day. But in your exam, most likely you're gonna have a bunch of temporary differences. You're gonna have like 4, 5, 6, and for multiple years. So what we're gonna do, we're going to go through them one by one. We're going to do the transactions for them one by one. So, question 3, Home Use Products Inc. uses IFRS, using IFRS, provided the following information about its first 3 years of operations. In its first year of operation, the company used installment sales to promote its products. The company reported $4,000 in installment sales gross margin for the period. It did not have any installment sales for the next 2 years. Home use cash collection pattern on the installment sales was 15%, 25%, and 60% in the first year, second year, and third year, respectively. Home use uses the straight line depreciation for book purposes and recorded $10,000 in each of the first 3 years as depreciation expense. For tax purposes, it recorded $17,000, $12,000, and $9,000 in CCA in each of the first 3 years, respectively. Home use uses the allowance method to recognize bad debt expense for accounting purposes and recognize $5,000, $7,000, and $6,000 of bad debt expense in each of the 3 years. For tax purposes, it was permitted to deduct only the actual amount receivable write-off, so the actual losses incurred. Accordingly, deductible amounts were $0, $4,600, and $6,500 of bad debt expense in each of the first 3 years, respectively. Home use recorded a $6,000 contingent litigation liability in year 1 for accounting purposes. This was disallowed for tax purposes and which would be deductible only when the liability is paid. In year 3, it paid $1,200 of this liability. In each year, the firm received $1,000 as a municipal subsidy given to new startup enterprises. These are non-taxable subsidies. Home use reported accounting income before tax of $18,000, $13,300, and $26,500 respectively in each of the first 3 years. Assume that home use operates in only one tax jurisdiction and its statutory tax rate in year 1 was 35%. However, during year 2, the government enacted a change in tax rate to 40% for year 2 and following years. So first, we're going to prepare reconciliation between the financial and taxable incomes for the first 3 years and the amount of income tax in each year. And then we're going to prepare all of the income tax for the journal entries for year 1 and 2 only. So, big problem. I hope you're still awake. So I'm going to set up year 1, year 2, and year 3. Always start with your accounting income. So here they said that the income before tax was $18,000 for year one, $13,300 for year two, and $26,500 for year three. Then we want to look for permanent differences. There's only one here. There's only the municipal subsidy. So the company, the subsidy, increased their accounting income for year 1, 2, and 3 by $1,000. But tax doesn't allow for that amount in their taxable income. So you want to come and reduce your accounting income by $1,000 to reflect the tax laws. So your municipal subsidy minus $1,000 in year 1, in year 2, and in year 3. So here, so your income after the permanent differences is $17,000, $12,300, and $25,500. Then you go in with your temporary differences. The first one they talked about is the installment sales. So the company reported $4,000 in installment sales for the first year. So in their books, in their sales revenue, they have $4,000. But did they receive the full $4,000 in year 1? No, they only received 15% in year 1. But in year 2 and 3, they received the 25% and 60%. So you want to correct this difference here to get to your taxable income. So first, what I'm going to do is I'm going to remove the amount that was accrued under accounting. So I'm removing $4,000. I'm removing it because since it was included in my accounting income here, it increased my accounting income, but I want to decrease it to get to my taxable income. I want to remove it from the accounting income. Then you have your installment sales under tax. So that's the amount that you actually collected from the installment sales each year. So for year 1, you collected 15% of $4,000. So you want to add it because your income cash, the amount cash I received is only $600. In year 2, it was 25%. And in year 3, it was 60%. I'm gonna do the journal entries right here at the same time. For year 1, what's your journal entry? You have to look first, well, is it going to be a deferred tax asset or liability? Here, if we look, we removed the $4,000 and we added back $6,000. So what happened in year 1 is that your taxable income, because of this temporary differences, is $3,400 lower than your accounting income. So you're paying less taxes this year because of that temporary difference, but in future year, you're gonna have to pay more taxes. So you're gonna set up a liability. Also, it's a negative amount. If it's a negative amount here, you set up a liability. So you're gonna have a deferred tax expense and a deferred tax liability. And the amount is going to be your tax rate for year 1, 35% times the $3,400. That's for year 1. For year 2, what happened? Well, now you didn't record anything linked to the installment sales, but you did receive cash $1,000. So you want to come and reduce the deferred tax liability that you set up in year one by this amount. But because there was a change in tax rate, you're going to have to take that in consideration and increase your deferred tax liability and deferred tax expense by the amount of difference of your change in tax rate. So by 5%, because in year two, your tax rate is going to be 40%. So first, you want to do the change in tax rate. So you want to increase both. So you want to do $400,000 times 40% minus 35%. So you're increasing your deferred tax liability by $170. Then this is for your temporary differences in year two. You want to come and reduce your deferred tax liability for the $1,000 temporary difference. So deferred tax liability, deferred tax expense / benefit. So it's going to be $1,000 times 40%. So here what happened? Your DTL account, your deferred tax liability account. I don't have enough. Okay. You have your debits here, credits. So in year one, you had a deferred tax liability of $190,000. Year two, you increased it by $170. And then in year two, again, you're decreasing it by $400. That means at the end of the day, your balance in your DTL account is going to be this amount, the amount from year one, $170 minus your $400. So you're going to have in your financial statements a deferred tax liability of $960 linked with your installment sales. All right, let's continue. Home uses the straight line depreciation for book purposes and recorded $10,000 in each of the first 3 years as depreciation expense. For tax purposes, it recorded $17,000, $12,000, and $9,000 of CCA in each of the first 3 years, respectively. So first, you want to remove your depreciation expense. Since your depreciation expense reduced your accounting income here, you want to put it as a positive. So you're going to add $10,000 in each of the 3 years. And then you're going to want to take out.
Sorry, can you just go over that again? Sorry, you know, in the PowerPoint slides, like there was that slide that about how to calculate the current tax expense, and I think it's slide 9.
Yes, here.
Yeah, is this what you're following right now to calculate the depreciation? Whether it's
yeah. So right now, what I'm doing is these 3 lines.
Okay, so like right now the depreciation, the 10,000, we're adding it because it wasn't included in the accounting income.
We're adding it because it was included in the accounting income. So if your accounting income right now is here, let's say, and it was $18,000. Your depreciation expense is before your accounting income. And what you did in your income statement, you put it as an expense for $10,000. And then let's say here you had nothing else, so you had sales revenue of $28,000. So if your depreciation was your only expense, that's the only thing that reduced your accounting income, right? So what you want to do is, because it reduced your accounting income, you want to put it as a positive here to cancel its effect on the accounting income.
Okay, because I understand what you just explained, but it's just like when I look at the PowerPoint slide, I'm trying to find like how I would follow that, like what's written on the slide.
Yeah, so here you're putting it as a plus because you're removing expenses that were included in the accounting income.
Okay, okay.
Yeah, I know it's confusing to know when it's a plus and a minus. Honestly, it's just with practice that it kind of clicks.
So
Yeah.
like, so knowing whether it's a plus or a minus, that's with practice. Like it's not following what's on this slide that I'll be able to figure that out.
Well, you can look at this slide. You can see like, okay, well, am I adding revenues like cash that weren't included in my accounting income? If that's the case, then I have to put it as a plus in my like little calculation here.
Because like in this case, depreciation is an expense, right? And like according to this, doesn't it say that it would be removing expenses that were included in accounting income?
Yeah. So you're putting it as a plus in your calculation.
Okay.
Got it?
I think I really need to practice because like I'm still pretty confused, but okay.
Yeah. Tell yourself that right now it's hard, but if
Yeah.
you tackle for 40, this is going to be a piece of cake because you're going to have to learn it. So
Okay.
it's a learning curve right now, but it's going to be easier for you in other classes.
Okay.
Yeah. So good luck. But honestly, yeah, practice the most you can with the book problems. I think it really takes like one situation at a time instead of like having all of this at the same time. So you kind of see the effect of one item at a time.
Okay.
Yeah.
Thank you.
Sorry, I kind of jumped.
No, it's okay.
It's so silent.
Okay.
All right. For CCA. So here, so you added back your depreciation expense. So CCA is the actual depreciation that should have happened. So you're going to remove the $17,000. You're going to remove the 12, I'm looking here, the $12,000 and the $9,000. So this is the depreciation amount under tax. So this comes and reduce your income for tax. So for the transactions, right now, all I'm recording is the deferred tax accounts. I'm not calculating the current, like the amount of taxes I'm going to pay. That's going to be at the end. So for the depreciation slash CCA, I did not write that correctly. For year one, so the effect for year one is that it increase your taxable income by $7,000. So you're paying less taxes this year, more taxes in future years. So it's going to be set up as a deferred tax liability. And it's going to be the sum of the two difference. So $7,000 times your tax rate in year one, so 35%. For year two, you have to take into account the change in tax rate. So you want to increase these two accounts by 5%, like we did for installment sales. So it's $7,000 times 5%. And then you want to record the temporary difference of year two for these two. So here again, the temporary difference between the depreciation expense and the CCA creates a reduction in taxable income of $2,000. So again, you're going to increase your deferred tax liability by $2,000 times your tax rate for year two. Deferred tax expense and deferred tax liability. So it's going to be 2,000 times 40%. All right, that's it for depreciation. Then you have the bad debt expense. So your bad debt expense for ACCO purposes, this is an estimation. It's not the actual amount of deductible amounts for tax purposes. This is what you record in your books as an expense. So like we did here, instead of having depreciation, you have the bad debt expense. And in year one, you put $5,000. So reduced your accounting income by $5,000. So you want to add it back to get to your taxable income. So you want to cancel its effect. So you're going to add back $5,000 in year one. In year two, it's $7,000. And in year three, it's going to be $6,000. Now you want to see at the bad debt expense under tax. What happened? What's actually going to go in your income, your taxable income? So for year one, the deductible amounts were $0. Year two, $4,600. And year three, $6,500. So your transaction. For year one. Impact here of the temporary difference between accounting and tax is $5,000. So it increased your taxable income by $5,000. So that means it's an asset. So you're going to have a deferred tax asset and a deferred tax benefit. And it's going to be $5,000 times your tax rate of year one of 35%. Year two, you have to record the increase in tax rate. So same thing as here. It's going to be $5,000 times 5%. Tax rate, changing tax rate. And then in year two, we want to see what's the impact of the temporary difference. Temporary difference. Oh, sorry. Here it's supposed to be minus 4,600, minus 6,500, because it's the actual amount that we're deducting from our taxable income. So for year two, it creates a temporary difference of 2,400 positive. So it increases our taxable income by 2,400. So we're going to increase our deferred tax asset. So we're going to increase it by 2,400 times 40%. Right. Right, bad debt expense, that's it. And then your contingent litigation liability. You record it as an expense. Where is it? $6,000 in year one. You're going to want to remove it. And then contingent liability tax. You actually paid 1,200 in year three. So here there's no effect, nothing. Transaction, contingent liability. Year one. So in year one, sorry. You're removing the expense, so you're adding it back to your income, to your taxable income. So that creates a temporary differences of $6,000 positive. So that creates a deferred tax asset. of $6,000 times 35%. And then year 2, we have to account for the change in tax rate. So you're increasing your deferred tax asset, deferred tax benefit by 6,000 times 5%. And then we're going to look at the temporary differences for year 2 for the contingent liability. There's no impact. So there's no entry for the temporary differences for year 2. All right. So we recorded all the transactions that happened. So now we can find our taxable income for the 3 years. So it's going to be starting from your accounting income and plus or minus your permanent differences. You're going to add all of these together. And that gives you your taxable income. Then your tax rates for year 1 is 25%. Oh, sorry, it's 35%. And then it's 40%, 40%. And then your current tax expense is your taxable income times your tax rates. So for year 1, it will be current tax expense to income tax payable of $6,160. So that's the amount of taxes that you're going to pay. And then for year 2, it's going to be same transaction, but the amount is going to be $5,480 instead. All right, so we did all the transactions, we did everything, but instead of doing all of this here, all the transactions that I did to record the deferred tax expense, the liability and everything, a trick that you can use is you sum all your temporary differences together. So sum of temporary differences for year 1, for example. That's going to give me $600. It's a positive. So since it's a positive, I'm going to record a deferred tax asset to a deferred tax benefit. And it's going to be $600 times our tax rate. So this amount is equal to this plus this plus this plus this. So here, I'm going to have my year 1, my deferred tax assets, and my deferred tax liabilities I recorded. Tax asset, I recorded one for my bad debt expense and for my contingent liability. I think that's it. And then my deferred tax liability, I recorded one for my installment sales and my depreciation expense. So if you sum these together net, you have a deferred tax asset of 210, and it's the same amount. So no, we didn't do it in year 3 because it only asked us for year 1 and 2 to record a transaction. But if you want to do it, we can. Just have to set this up. So for year 3, what it would have been, you would have reduced your deferred tax asset by the temporary difference of 1,200 times 40%. So it would have been a deferred tax expense to deferred tax asset, 1,200 times 40%. Yeah, that's for year 3. So this is a trick, goes a lot faster in exams. The reason why I did all of this is because they asked for all income tax related journal entries. But since your exam is going to be multiple choice, you can just set this up and just look at the sum of my time period differences and see, is it positive, negative? If it's positive, I record a deferred tax asset. If it's negative, a liability. And you're pretty much done. So that's it for the tutorial. Do you guys have any questions?